Welcome back to the deep dive. Today we are taking a really close look at Jubilant Ingrevia Limited JIL, specifically their Q2 and H1 FY26 performance.
And our source material is fresh, comes straight from their investor presentation and the earnings call they just held, October 27, 2025.
Right, so this is timely stuff.
And this deep dive is, well, particularly relevant for you, the listener, because JIL is showing some remarkable strength. Especially when you look at the global picture.
You mean the broader chemical sector?
Exactly. It's frankly devastating for many out there, Europe in particular. You've got established players really struggling with demand, cost pressures. It's tough.
Okay, so JIL's performance stands out. Our mission today isn't just about reading numbers, right? We want to get into the mechanics of their success.
Yeah, how are they actually doing this? We're sort of looking at what we're calling a dual strategy.
Okay.
So on one hand, a really focused offense, pushing into high-growth areas like custom development and manufacturing CDMO. And on the other hand, a pretty aggressive defense through operational efficiency.
Offense and defense. Got it.
And you can see that strategy paying off right away in the headline number.
Which is?
JIL reported the highest quarterly revenue and sales volume they've seen in the last 10 quarters. 10 quarters.
Wow. Okay, that's a big statement, especially, like you said, given the market.
It tells you they're executing right now, effectively, despite everything.
All right, let's unpack that financial resilience then. How did they get to that top number? Q2 FY26 financials.
Okay, so total revenue came in at 11,121 crore.
And just for context, a crore is 10 million rupees. So 11,121 crore is roughly, what, $135 million USD?
Yeah.
Gives you a sense of the scale.
Exactly, and that 11,121 crore, it represents a solid 7% year-over-year revenue growth.
7% growth. But what's behind that? Is it just prices going up?
No, and that's the crucial part. The source material is really clear here. Pricing across the industry.
Yeah.
Flat, maybe even under pressure.
Oh.
So that entire 7% revenue increase, it was powered by volume. Impressive high double-digit volume growth, around 18% year-over-year.
18% volume growth. That's huge. So they're not just writing inflation, they're actively taking market share.
That's exactly it. It proves the demand for their specific stuff is accelerating. They're using their capacity better.
Okay, so volume strength. What did that do for their actual profitability, the bottom line?
Improved it substantially. Their EBITDA, earnings before interest, taxes, depreciation, amortization, that grew 8% year-over-year, so slightly faster than revenue. And critically, their profit after tax, PAT, that surged 18% year-over-year just in the quarter.
18% PAT growth. Okay.
And if you zoom out and look at the first half of the year, the H1 comparison, tech growth is even more dramatic, up 34% compared to H1 last year.
Wow, okay. That 18% PAT T surge in Q2.
That's got to be volume, plus something else we need to get into later, right? Cost control.
Absolutely. But let's stick with the context for a sec. You mentioned the struggling global situation. How bad is it elsewhere compared to JIL?
Right, how stark is that comparison? Well, stark enough that JIL's management called it out directly in the presentation. You have many global chemical majors, especially those in, say, the highly regulated European markets.
Yeah.
They're reporting, and this is the term they used, deteriorating financials.
Yeah.
They're battling structural issues. Weak demand from end users, still dealing with those high energy costs.
Which we know are crippling in Europe.
Crippling. And persistent inventory destocking still working its way through the system.
So when JIL drives 18% volume growth and 18% PPT growth, I mean, they're essentially swimming upstream against a really strong global current.
Precisely. They seem to be absorbing that global price pressure by maximizing their own efficiency and, yeah, aggressively capturing share where maybe others are pulling back or just can't compete because of high legacy costs.
Did JIL give any hints that the broader market might be turning a corner, even if they're doing well personally? Any stabilization signals?
They did, actually. Pointed to a couple of sectors showing, let's say, recovery trends. Like, first, agrochemicals. That's a key segment for them. They said it's successfully moved beyond the inventory destocking phase.
Okay, that's a pretty big signal for the whole industry.
Huge. Volumes are stabilizing, and they're actually seeing growth again. Second, the pharmaceutical segment. That continues to deliver steady volume growth, stable pricing. And they noted a small but significant recovery, specifically in paracetamol volumes.
Interesting. Okay, good context. Let's shift gears now. You mentioned the dual strategy. Let's talk about the offense side, the growth engine in specialty chemicals.
Right, specialty chemicals. This is where the story shifts from, resilience to active expansion.
This is the exciting part.
This is where the momentum is. Strong double-digit year-over-year revenue growth again in this segment. And the margins. Look at the margins. They reported a 26% EBITDA margin during the quarter.
26%, that's pretty hefty for chemicals.
It's incredibly attractive. And that kind of margin profile, that's clearly what's driving the overall profitability improvement for the whole company.
So what specific products or areas within specialty are generating those high margins?
It really comes down to two things: strength in fine chemicals and the rapidly accelerating CDMO sales, custom development, and manufacturing.
CDMO again?
Yeah, they specifically highlighted high double-digit growth in key chemical intermediates, pyridine and diketene derivatives.
Okay. For listeners maybe not deep in chemistry, pyridine, diketene derivatives, why are these so important for JIL? What makes them special?
Well, what's fascinating is that these aren't basic commodity chemicals. They're highly specialized intermediates. Think of them as complex building blocks
Building blocks for what?
for creating really complex, high-value end products. Things like advanced pharmaceuticals, cutting-edge agrochemicals. JIL's developed some pretty complex multi-step manufacturing processes for these.
So it's hard for others to copy. High barrier to entry.
Exactly. By excelling in these, niche, difficult chemistries, they essentially lock in high-margin contracts with innovators who need these specific molecules.
Okay, that explains the profitability. But thinking about the future, the potential pipeline in CDMO sounds huge. You called it an aha moment earlier.
It really is, and it speaks volumes about their customer focus. JIL expanded its opportunity funnel now to over 100 active opportunities.
Over 100. Wow, what was it before?
It was around 70 just in the previous quarter, Q1. So a big jump.
Okay, 100 opportunities, and what's the potential value attached to that?
Collectively, those 100-plus opportunities, they represent a potential peak annual revenue of 3,500 crore.
Whoa, 3,500 crore potential peak revenue?
Yeah.
That sounds enormous. I have to ask critically, though, how much of that is just, aspirational talk from management versus a solid, realistic pipeline? What's their track record of converting these opportunities?
That's the right question to ask. And management seemed ready for it. They provided the proof points by highlighting confirmed contracts.
Okay, actual signed deals?
Right. Over just the last 12 months, JIL secured confirmation for over 10 new molecules. These confirmed deals are expected to contribute over 1,200 crore of peak annual revenues.
1,200 crore confirmed. Okay, that's substantial.
It is. The fact they can point to 1.2 billion crores, 1,200 crore worth of potential being translated into firm agreements. It demonstrates that the 3,500 crore funnel isn't just smoke and mirrors. It's got substance.
Let's hone in on the biggest confirmed win they've talked about before. That big $300 million agro-innovator project. Any updates? What milestones did they hit this quarter?
Yeah, good progress there. They successfully delivered the initial volumes in Q2 against a new agro CDMO innovator contract. Not the big one, but a different one. That helps validate their production capability.
Okay, but the main one, the $300 million deal.
The big one, the $300 million agro innovator contract that remains firmly on track. They specifically reiterated that commissioning for that huge facility is still scheduled for Q4 FY26.
Q4 FY26. And based on that project size, $300 million over what? 5 years. That implies an annual revenue potential of around 500 crores just from that one project.
Correct. Roughly 500 crore a year. And they're not just waiting for it to happen. They're backing this growth up with actual investment in capacity.
How so?
To handle this overall surge in CDMO demand, they've already broken ground on a new multi-purpose plant, an MPP in Gajraula.
Another new plant.
Yeah. This facility is targeted for completion by late 2026. So they're making sure they have the infrastructure ready to actually produce and scale up these confirmed contracts when they fully come online.
Okay, makes sense. Let's transition now from the high-flying, high-margin specialties business to the nutrition and health solutions segment, vitamin B3, B4. The story here sounds quite different. High volume, but facing profitability issues.
Yeah, it's a very different kind of fight in this segment. On one hand, they achieved record high volumes. Both vitamin B3, niacinamide, and B4, choline hit record levels on a year-over-year basis. So volume itself isn't the problem.
Record volume. But despite that, the segment revenue actually declined slightly, -1% year over year, and EBITDA margins were stuck way lower, around 12%.
Yeah.
Why the disconnect?
That margin pressure, that disconnect, it's due to what they call short-term volatility and really intense competitive pressures, specifically in the global market for feed-grade vitamins.
Feed grade. That's the key detail.
Crucial detail. When your main customer base for vitamins is the animal feed industry, pricing gets extremely sensitive to global commodity cycles, over supply issues, things like that. So JIL basically had to play defense here.
And their defensive move is to pivot towards higher value grades. How are they doing that exactly?
They're actively ramping up production at their new CGMP facility,
BGMP.
current good manufacturing practices. It's a stringent quality standard, basically essential if your products are going into the human supply chain, food, cosmetics, pharma.
Right.
So by using this new compliant facility, they're accelerating growth in the higher value cosmetic and food grade B3 sales. These markets are generally less price volatile.
And command better margins.
Exactly.
Yeah.
They get a significant margin premium compared to the basic feed grade products.
So basically, selling specialized B3 for a high-end face cream or fortified breakfast cereal is a much better, financially safer business than selling bulk B3 for chicken feed.
Absolutely. That's the strategy. And apparently, the plan is working. Management said they expect margins in this segment to recover pretty sharply, getting back into the 16% to 18% range as the proportion of these specialized, high-grade products increases in their overall sales mix.
Okay, 16 to 18% target, that's a healthier number. Now, there's also an interesting external factor helping their choline business, right? Something about EU policy.
Yeah, this is a great example of how, outside factors can suddenly create opportunity.
Mm.
The European Union recently imposed an anti-dumping duty specifically on choline products coming from China.
Okay, so that restricts Chinese supply into Europe.
Right, and that policy shift has instantly created what JIL called a good pipeline opportunity for them in Europe.
Yeah.
They actually booked some early orders related to this in Q2,
Mm-hmm.
and now they're actively positioning themselves to scale up significantly in Europe as their own product approvals get finalized across different countries.
Yeah.
They're basically stepping in to fill that supply gap left by the Chinese suppliers.
Interesting. Okay, so if CDMO is the immediate offensive growth engine, let's talk about the longer-term offense. The strategic moves into really cutting-edge areas. This is their 5 to 10-year bet, you could say.
Mm-hmm.
And nothing highlights this more than their recent announcement about semiconductor chemicals.
Yeah, this is the really forward-looking piece that frankly sets them apart from many more traditional chemical companies. JIL announced concrete plans. They're actually building a state-of-the-art semiconductor R&D facility
Where?
in Greater Noida. They're investing in highly specialized equipment, dedicated R&D teams specifically for this purpose.
Okay, hold on. Why is a company known for things like pyridine derivatives and vitamin B3 suddenly focusing on something as high-tech and seemingly different as semiconductor materials?
It's about diversification, really, and future-proofing the business. Electronic chemicals, the stuff used to make computer chips, they are incredibly high-purity, very high-value products.
Right.
And they require deep technical expertise to produce consistently. Now, management themselves noted, yes, this is a 5 to 10-year journey. It's not immediate revenue.
Yeah.
But it signals a clear commitment to moving up the value chain.
Yeah.
Moving towards industries that are globally strategic, probably less susceptible to the boom and bust cycles of some bulk chemicals. It's a bet on intellectual property and high-tech manufacturing over just commodity volume.
So it sounds like they're trying to build entirely new pillars for the company over the next decade. Beyond semiconductors, what does the rest of their current innovation pipeline look like, R&D in general?
It's pretty robust across their existing businesses, too. They mentioned having approximately 50 products currently under development across their various segments.
50 products.
Yeah, all focused on, differentiated value-added solutions, not just Me Too stuff. And they expect to actually launch 18 new products in FY26 alone.
18 new products next fiscal year. That shows a pretty intense focus on churning out new revenue streams quickly.
Definitely. Constant refreshment of the portfolio.
Okay, so we've covered the offense, both immediate CDMO growth and long-term high-tech bets. Now let's circle back to the defensive side of that dual strategy you mentioned, operational excellence. We can't really understand that 18% PET surge without talking about efficiency, right?
Absolutely not. The cost story in Q2 was phenomenal, and it directly propped up the bottom line. Big news here was commissioning renewable O2 power at their Baruch site.
More green energy.
Yeah, and it pushed their total renewable power share up to 28%, which is impressive. But this isn't just, an ESG initiative. It's a massive financial defense tactic.
And you can see the tangible financial result immediately.
Oh, absolutely. Power and fuel expenses, a major cost for any chemical manufacturer, dropped significantly by a remarkable 16% year over year.
16% drop in fuel costs.
Yes.
Yeah.
Now think about that for a second. They increased their production volumes by 18%.
Right.
But their power and fuel costs went down by 16%.
Wow. That's serious operational leverage.
That is operational leverage paying off in spades. It directly counteracts that global pricing pressure we talked about. This efficiency is the mechanism that helped translate strong volume growth into even stronger PAT growth.
And this discipline isn't just about energy, it extends to their internal savings goals, too.
Correct. They have an ongoing internal program aiming for 100 crore per annum in lean savings, just finding efficiencies everywhere. They reiterated that this program remains firmly on track.
Okay.
So it reinforces the whole narrative. Q2 wasn't just about winning new contracts and growing volume. It was equally about executing with extreme cost discipline. And that discipline is absolutely essential for surviving, let alone thriving, in the current global chemical downturn.
Okay, so let's try to synthesize all this. Q2 FY26 for Jubilant Ingrevia. It really seems like the quarter where they prove their strategic projects, especially in CDMO, are maturing and starting to deliver, while simultaneously using that operational efficiency, that cost control, as a really powerful shield against the storms in the global market.
That sums it up perfectly, I think. They navigated this persistent market turbulence through those two key drivers you mentioned. First, leveraging market share gains via high volumes.
Right.
And second, strategically translating those volumes into better profitability by keeping an incredibly tight grip on costs. Best exemplified by that huge 16% drop in energy spending.
So the offense provided the growth.
The offensive growth engines, yeah, particularly CDMO, they provided the excitement, the upward momentum. But the defensive operational excellence, that provided the stability, the resilience.
Which brings us to a final thought, maybe something for you, the listener, to mull over. We've seen JIL making these concrete, very visible investments in next decade technologies. That 5 to 10-year bet on this semiconductor R&D facility is a prime example.
Yeah, a big strategic leap.
But at the exact same time, they're squeezing every last drop of efficiency out of their current operations. That 16% drop in fuel costs is just incredible tactical execution. So the question is, how many other, traditional chemical companies out there in the world are currently demonstrating both that kind of strategic audacity for long-term high-tech pivots and that level of tactical discipline for immediate best-in-class cost management?
It's a good question. It really makes you wonder which companies are truly setting themselves up, not just to survive the current cycle, but to lead in the next wave of industrial evolution, whatever that looks like.
Something to chew on until our next deep dive.